When unexpected news breaks and the market flashes a sea of red, the natural human response is sheer, unfiltered panic. There is an entire field of study dedicated to this, called behavioral finance. It proves that everyday traders consistently make irrational choices, selling at the worst possible time because the fear of losing money overrides logic, or buying at the absolute peak just because everyone else is doing it. Picture the stock market as a giant blindfolded game of tug-of-war. On one side, you have retail traders pulling on the rope. Because they can't see the mechanics of the market, they adjust their grip based entirely on the emotional screams and cheers of the crowd around them. But on the other side of that rope are top-tier financial institutions. When a crash happens, they don't see a disaster. They see a highly predictable, highly profitable harvesting ground. Institutional algorithms are specifically built to harvest human panic as a raw resource. High-frequency trading algorithms do not look at traditional price charts, and they certainly do not feel panic during a crash. Instead, these machines rely on a sensor called order flow imbalance. Think of it as a highly sensitive pressure scale. The algorithm ignores where the price is currently sitting and measures the exact physical difference between the weight of incoming buy orders and the weight of incoming sell orders. Here is our digital tug-of-war. On the left, human sellers are yanking the rope in a chaotic panic. But notice the machine on the right. It completely ignores the price line above, and a digital gauge measures the exact physical strain on the rope. By reading this raw pressure data, the algorithm knows the precise millisecond the human side is exhausting its energy and is about to lose its grip. This data advantage is built directly into the streets of New York. Look closely at the street sign. That gray box above it is a microwave transmitter. Institutions use these to beam trading data through the air because microwaves travel faster than light moving through underground fiber optic cables. By ignoring the emotional price chart and reading the raw pressure of the rope, machines know exactly when to strike. They execute a strategy called volatility arbitrage. This is essentially a high-speed way of buying an asset in one place and selling it in another at the exact same time to pocket the difference. They scoop up guaranteed fractions of a cent every time the human side of the market loses its footing. But if the market is violently crashing, how do these machines step in to buy without getting wiped out alongside the retail traders? The answer is a concept called dynamic position scaling. A human trader usually buys a fixed, stubborn amount of shares and holds on tight. An algorithm treats its trade size like an automatic volume dial. Inside the algorithm's gearbox, when the market line is calm, the system expands its trade size to maximize returns. But the millisecond the line turns jagged, the system instantly shrinks its trade size to a tiny fraction. It reduces its footprint so dramatically that it can safely wander through the chaos, picking up heavily mispriced assets while exposing almost none of its core capital to the crash. Survival in high-frequency trading relies on a system that automatically shrinks your physical exposure the instant the rope begins to vibrate. Retail traders approach the market looking for a massive overnight jackpot. Tier 1 institutions do not care about hitting a home run. Take a look at this split-screen graph. The top screen shows the human goal, a volatile, jagged profit line filled with massive, stressful peaks and terrifying valleys. The bottom screen is the institutional ideal, a smooth, gently ascending, entirely boring profit line. Wall Street grades this using the Sharpe ratio, a strict mathematical score that tracks exactly how much stress and risk you had to endure to earn a single dollar. Every single tool we've looked at, measuring the tension on the rope with order flow imbalance, or instantly shrinking the trade size when volatility spikes, exists solely to optimize that one ratio. Over a long enough timeline, risk-adjusted consistency mathematically defeats luck. To survive the market's tug-of-war, you must trade based on what the underlying data proves rather than how the crowd makes you feel.